Okay, let's see here. I have the lower high here, and I see that there's a downtrend. And seems like the price have broken through the support level. Maybe I should give it a short position. Hello traders, welcome to Technical Analysis Workshop with Nimbus Capital. Today we are going to talk about trading with trend, and the chart that we will be looking at is Apple, as you can see right here. So it occurs to me that many traders are still confused about what following the trend means. This is understandable as depending on the time frame, the trend can change. So for example, if we are looking at a short-term time frame, maybe the trend might be down, but if we look at a broader time frame, the trend can be up. So which is the trend that we have to follow? The reason why we are looking at Apple is because one of the subscribers asked if it is okay to short sell Apple at this point. His justification being that this point that you see right here is a lower high. Price is coming down, hence forming a downtrend line. Moreover, there is also a pin bar candle or shooting star red candle that is appearing here, which suggests that sellers are coming in. While his explanation sounds reasonable, there are a few gaping flaws. First, let us look at the long-term trend by zooming out. When traders are interpreting a chart, the common mistake made is they look at the candle first before anything else. My personal habit is to immediately zoom out the chart to look at the long-term trend. We will now call the long-term trend as the primary trend. And as you can clearly see here, the primary trend is up. Within the uptrend, you will find many short-term downtrend, and we will call this the secondary trend. So as trader, we will always want to be trading with the primary trend. This is because secondary downtrend lasts very short, and the window for entry and exit are extremely narrow that it is actually not worth trading those narrow time frame, mainly because most of the time you might end up missing your entry, or you might end up missing your profit level, and you might not get a good profit anyway. You tend to end up trading the noise rather than trading the secondary trend itself. Hence, it is best not to trade the secondary trend. In our case with Apple, just by its primary uptrend that you see here, short selling is already out of the question. So we do not even need to dive deeper and look at the chart structure or the candle itself. Next, let us look at how we draw trend lines. Trend lines are generally formed by two or more established points, and they are kind of, in a way, a confirmed support since price have already rebounded. So for this chart, we can draw the trend line something like this. Or if we want to input the most recent established support that we see right here, we can actually draw the trend line like this as well. But however you draw it, one thing is clear is that the trend is up. As we go deeper into this recent portion that you see right here, we can clearly see that the price is still sideways. This point at 150 is still not considered established. Hence, we cannot prematurely assume that this is the lower high. So that is where the first trader mistake will comes in. Because if we take a point that have not been established yet, then we run the risk that actually this is not even a lower high. Price is just kind of going sideways a bit before it can continue to trend up, and hence the short position is not even valid. At this point, we can see both trend and chart structure is already invalid for a short position. Thus, we do not even need to analyze the candle already. On the other hand, the argument for a long position might be more favorable because we already have an established primary trend that is going up. If we look at this point at 140, this is already an established lower high. Price have already rebounded. Moreover, if we zoom out into a weekly time frame, we can also see very clearly that this level is a resistance turn support level. Previously, it was resisted here. Now it has become a support level. So in an uptrend, this kind of resistance turn support level is one of the strongest support that you can actually plan your long position and your stop loss around. But do remember that this only works in an uptrend. So please do not go and choose a downtrend chart and then you start looking for resistance support level. That's not going to work. This is only work on uptrend. So given that we have such a strong support level at somewhere around 140, we can actually plan our stop loss to be somewhere about 130. This is one of the safest stop loss level that you can get. We do want to provide a little room so that should the price come down with a high momentum, we do have a little bit of breathing space for the price so that it can rebound back up. There is one concern with the long position play, the resistance at price 157. Also take note that this resistance level is already an established level because we have seen the price came down after touching this level. So the current price that we are looking at 150, it is exceptionally close to the resistance, meaning we have to consider the possibility that price can actually go up, get resisted, and then it will start to come down and maybe it will start to consolidate or go sideways before attempting to break the resistance level again. So if you do not have the holding power, maybe entering the trade at 150 might not be a good idea. However, you can consider the alternative, which is to wait for the price to actually break out of the resistance level first before you even take the trade. So once the price have broken out of the resistance level, you can place a trade by a mean of buy stop order, or you can even place an alert at say 159 to kind of alert you that hey, price have broken out of the resistance level. So now that you are entering at a higher price, what you will realize is that your stop loss is now slightly wider compared to say if you are entering at price level of 150. So because of this, you might want to adjust your lot sizing so that you can maintain your risk. Hence, waiting for breakout also have its disadvantage as you will not be able to buy more share without increasing your risk. So whether you choose to buy before the breakout at 150 or buy after the breakout at 160, I believe that this is a matter of preference, whether do you like to hold or do you prefer a breakout trade. However, when we are talking about choosing between a long position and a short position, I would say that long position will have a much higher probability of success compared to the short position. Remember, folks, always trade with the trend. If the trend and the chart structure is a no-go, then you don't even need to look at the candle itself. So we have come to the end of the videos. Thank you guys for watching, and please remember to like this video and subscribe to our channel. It means a lot to us as our channel is still growing, and having more likes and subscribers means that we will be able to create more videos and more quality content in the future. Once again, thank you so much and have a nice day.